Let's get a check on the markets right now with Gaurav Malik, and who's the chief portfolio strategist at State Street Global Advisors. Also, Carrie Firestone, who's the CEO of Arias Asset Management and a CNBC contributor. And Carrie, I'm going to start with you this morning because to this point, buying on the dip has always been the smart move. Do you think that is the way to go this time around, too?
Hi, Becky. So I think, yes, it depends, of course, where the stock is trading. We've had, I would call them rolling corrections that have gone over the last several months. Look at what retail has done in the past couple of weeks. You know, many of the stocks are down 20 to 30%. We've seen that in energy, a lot of technology stocks, home builders. And so a correction isn't just about the market as a whole. The S&P, we know, has fallen 5%. But if you've been looking at a stock to buy and it's down 20% and you think it's got great potential and is going to continue to grow, well, I think that makes sense to buy it now. But you can't just think about the market as a whole because we're in a little bit of a downtrend right here, and you have to be careful picking your spots.
We'll talk more about which spots you like versus those you don't in just a minute. But Gaurav, you've recently taken some money off the table, right? Just a little bit of risk that you've kind of pulled in on.
Yeah, we have just with the increase in volatility. I just want to be clear in saying that we still remain, very overweight on equities. We like commodities. In general, our bias is that we think we have a good, solid consumer in the U.S. We think economic growth delayed a bit because of Delta variant, but likely to come back up. So thematically, we still like the notion of playing these growth trades, whether that is through IT, semis, materials on one side, and then financials, we like those, and generally trying to avoid segments of the marketplace that maybe are not tuned into that growth theme. So some risk off the table, but I still want to stress that we're fairly overweight on growth and risk assets.
Gaurav, the tech stocks have been under pressure, at least recently, just especially as we saw yields start to pick back up. Is that something that you'd go against if you still like technology?
I know the yield moves are going to continue up and down and create some movements that are going to occur. I think this is more about long-term trends. It's more about the fact that the big move you've seen in digitization, e-commerce, the fact that the penetration in not only in internet, but also the fact that there is going to be likely some constraints on supply chains that are going to make semis look good too over the foreseeable future. So it's about those trades rather than trying to time a macro move in rates one way or the other. And just to be clear, our expectation on rates is something like at a 1.6 level for 2021, and we don't see much higher than 2 in the end of 2022. So even that would keep us invested in these assets.
I know you've both been watching the supply chain issues pretty closely. These are problems that don't seem to be going away. Carrie, what should investors do about that? What should they be on the lookout for when it comes to that, especially with earnings season coming up?
Well, with supply chain, we have to keep watching whether things are getting better. We heard that there are places in the home building area where suddenly there's more lumber available and there's products that are delayed and then suddenly you see them appear for different companies. We heard from SHERWIN-WILLIAMS, obviously, that they're having troubles with coatings and delivery. Again, we have to continue to monitor what's happening with companies, but there's more of a problem than we had expected. There's more inflation and there's more supply chain disruption, much of which is related to COVID. So the more vaccinated people are across the world, and you're talking about at factories in Vietnam, Malaysia, the Philippines, Long Beach, dock workers, factories in the Midwest and in Mexico, that's an evolving situation. So staying on top of that and remembering that with some industries, there is much more disruption than in others. If you're talking about Facebook and Google, there's not that much supply chain issues because their raw materials are mostly people. And they're also paying high wages, so there's less of a concern about what's happening on that supply side, more concern about just inflationary pressures on wages, which are already high in the technology industry. It depends, of course, by industry. But that is what the market is worried about right now. And when we see it come down, it's related to future earnings. Earnings for the third quarter are going to be less than or expected, and probably the fourth. It doesn't mean that will be true in 2022.